No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. You know, I've been talking a lot about, of course, the markets, and now that we are into the new year, and the markets being so important to understand, I mean, how to invest to stay ahead of inflation and taxes. This is one of the critical factors when it comes to planning for your retirement and assuring that you're going to have that retirement where you can attain and maintain your standard of living, your quality of life, no matter how long you live. Never have to worry about running out of money, right? Well, we need to know what's the needed rate of return on your money to accomplish that goal. And of course, I offer up each week, and I'm going to offer up again this week. If you would like some help getting that type of planning done for yourself, all you need to do is call my office at 615-376-5325. We'll get your information. We'll send you out a checklist of things to bring to your appointment with me, and I'll do up a comprehensive financial plan for you at no cost. This is a great way for me to be able to help you and also showcase the types of strategies that we use at my office at the same time. Now today, to kind of kick things off, I'm going to have joining us Phil Kosmala with Taiber Kosmala. He is the managing partner and chief strategist with Taiber Kosmala. 12 billion assets under management. They work with endowments, foundations, pensions, and a select group of individual advisors from around the country, registered investment advisors like myself as an example. With that, we're going to talk with Phil about the market and economic update, looking back over 2021, as well as in which market asset categories and market sectors outperformed in 21, and then which ones are poised to do the best, if you will, for 22 and looking forward. This might be it's a great time, in fact, to take an assessment of where you're at today, not looking in the rearview mirror of what worked then, but more importantly, what looks like it's going to be poised to work best going forward. We're going to also look at some of the things that we're going to cover, the historic pattern in midterm election years, such as this one, the Fed, we'll talk about that, inflation outlook, just try to give you as much insights as possible to help in planning for your retirement future. And again, joining me, Phil Kosmala. Phil, thanks again for joining us here this morning on the road. Glad you could come in. And one of the things I want to start with right off is the year in review. I mean, let's talk about 2021 and some insights that you've got from that.
Yeah, Hank, it had one heck of a year for us, for markets around the globe.
And Emily, we can get that first slide up, year in review for Phil.
The S&P 500, Hank, was up over 28% last year. And to put that in the annals of time, looking back at the history of the S&P 500, it's the 20th best year in the history of the S&P 500 index. So it was one heck of a year, but I think more importantly, Hank, is that's the second consecutive year of 20% gains. So really remarkable in terms of back-to-back 20% gains for the S&P 500. I wouldn't say it's unprecedented, Hank. I think that's a word that's abused too much in finance.
Yeah.
It's not unprecedented in the sense that it happened in the 1950s. After World War II, with the rebuild and all the stimulus that was added to the financial system and the global financial system then. But also in the 1990s, 1995 and 96, also had back-to-back 20% gains. So somewhat rarefied air, Hank, I think is fair to say. But when we look back at over time, you also see bond markets had only their fourth negative year in the past 50 years. And the chart on the right-hand side, and Hank, I know you've been a big proponent, rightfully so, of inflation index bonds. One of the few bond assets that was positive last year was inflation index bonds. And so when we look from that perspective, bonds and more aggressive, within bonds or bond asset classes, more aggressive bonds did well, meaning high yield, senior bank loans. Those are riskier type investments that, generally speaking, have a higher correlation to the stock market than they do the bond market. Right. But otherwise, it was a pretty rough year for fixed income investors.
And this is one of the things, Phil, as far as your mega cap stocks, what did the best last year as far as asset categories, and what you're seeing with regard to the stimulus and the effect that had on it, and what you see now that we're kind of past that, what that looks like for this year.
Yeah, Hank, that 28% gain for the S&P 500. it's a little bit misleading because 5 stocks accounted for a third of that gain. There were another narrow market share, and everyone listening in today, I know, and watching on TV has probably heard the concept of the FANGs. That's Facebook, Amazon, Apple, Netflix, Google, and Microsoft. And if you add NVIDIA, those of you that have kids that are into gaming, NVIDIA is the largest producer of chips for gaming consoles. If you look at those 6 stocks, since March 15th, I think they accounted for half of the market's gain. So this is 7 consecutive years. A very, very narrow swath of stocks have led the market. Normally, that's not healthy, but I think what we're seeing, rotation in markets, those stocks are very expensive. In fact, the S&P 500 right now, the top 10 stocks in the index, the broad market as we normally call it, Hank, are 30% of the value of the S&P 500. That's never happened in the history of the country. And those stocks are trading at very elevated price to earnings multiples or valuations, as we routinely call that, Hank. And when you look at it from that perspective, it looks very similar to the valuations we saw in the dot-com boom in the 1990s, early 2000s, where you had a handful of stocks that were trading at very rich multiples. The top 10 are trading at almost 37 times earnings. And what that means, people have heard of the PE ratio, the price to earnings ratio on the index itself. That normally trades at 16 times earnings. So it's double the historic valuation of the stock market.
So going forward, that usually would mean then that if you got high valuations, that doesn't leave as much room for growth, though it's done well getting there. Now going forward, not as much room for growth, whereas we've got some that are maybe that have underperformed, especially historically, like small caps international, and maybe they're poised for a better year.
We think so, Hank. After 7 years, the most powerful trend in finance, I know Warren Buffett said it's compound interest, and I think Albert Einstein also said compound interest is the most powerful force in physics. But if you look mean reversion, markets have a tendency to revert back to the historical averages. And when you look at how much growth stocks, technology stocks have outperformed values, and when I say value stocks for everyone watching today, those are your banks. You think of your energy companies, your basic materials companies, your Alcoas of the world. Those are trading at only 12, 13, 14 times earnings versus those technology stocks that are trading in the stratosphere at 37 times earnings. So, Hank, I think you hit the nail on the head there. We are starting to see a rotation where those value stocks are outperforming, and it's going to be more than those 7 stocks that lead the charge going forward. So we think now's a great time to reevaluate portfolios and start looking at some of the things that should mean revert that haven't performed as well the last 7 years. Value stocks, small cap stocks, international stocks, Hank, is something that we're very keen on this year. You have very comparable companies. When you think of an Exxon versus a Total, or you look at any of the big or Richemont versus any of our luxury retailers here in the United States, you're buying very similar companies, very similar growth rates, but you're buying them at a 33% discount overseas. Yeah. And so when you think about that, that's more downside protection, Hank, and that's something that we like in portfolios, is to have that buffer for downside protection.
Well, and this one other thing, Phil, when we're talking about, kind of putting that in historical context, when we see returns that we've seen in the market, more now on the bigger picture, following large gains, what that looks like going forward. So we know, for instance, in particular, we had 2018, which was off. That was the market was down about 5, but that was followed in 19, a 30% gain. In 20, I think we were up somewhere around 25, 26, something like that, and again in or maybe was it about 18, I'm sorry, and then last year was more up in that 20 mid-20 range. So how do you see that thing going forward when you had that big a run up, close to 80% in just a few years?
Yeah, Hank, our job is to be students of the market for endowments and foundations and pensions to help guide asset allocation decisions. And I've spoken in front of Nobel laureates, in front of vice chairs of the Fed, chairs of finance departments, and you have to have the historical, because that mean reversion of markets is really powerful. And so I think when we look back over time, we don't have a lot of analogs to back-to-back 20% years. It's only happened twice in the history of the country, as I mentioned earlier, in the 1950s and then in the 1990s. But what we do know, Hank, is the average age of a bull market. So studying markets over time, your average bull market lasts about 5 years in duration, or 60 months. and the average gain is 178%. And right now, Hank, we're 21 months into this bull market, and we're only up 113%. And with this 5% correction, only 108%. So again, if history is any guide, there still could be upside to this bull market as long as the Fed doesn't make a mistake in tightening monetary policy too aggressively. That would be, I think, the biggest risk that we have walking into California.
Yeah.
And Hank, I think that's part of the reason we have a 5% correction now, is the uncertainty surrounding Fed policy going forward.
Yeah, and that's going to be one of the trickier things, in fact, this coming year. And in fact, as you mentioned, Bill, earlier, I think the Fed's meeting again in a week, and we're gonna get some additional insights as to what that's going to look like. We're going to take a break. When we come back, in fact, Phil, I'd like to take up on that and talk a little bit about the Fed and the impact and what the potential concerns are there. But first, a break. Join us here. We'll be right back on the Retirement Report.